Greetings traders and welcome back. Thank you for joining me again. Chris here bringing you another In-Depth with Chris episode. Today we're going to be talking about a style of trading. You've probably heard about day trading and you've probably heard about position trading, but somewhere in between those two we have something called swing trading. It's not as short as day trading, but not as long as position trading. And there's a lot of benefits that can be had. So today we're going to cover all of that information, what it means to swing trade, and some of the best conditions that markets should exhibit when we're looking for a market to swing trade in. But without further ado, let's get going. Swing trading can be very appealing to traders that feel like they're constantly getting caught off guard by short-term volatility that is often associated with day trading positions. Today we're going to talk about exactly what swing trading is, how to understand the process, as well as compare it to day trading and position trading, and we're even going to talk about some of the swing trading market conditions that we want to see as we're choosing a market to swing trade in. At the end of all of this, if you feel so inclined and you feel so pumped up that you are going to just dominate the market, make sure you check out our Gauntlet Mini as well. So by the definition, what does it mean to swing trade, or what is swing trading? It is a trading style that utilizes technical analysis in an attempt to capture gains in a traded security over a period of a few days to several weeks. So we can sum up all of this and just say swing trading is the process of trading over a period of a few days to several weeks instead of trading positions that are being closed out within a single day. The goal for traders is to identify an overall trend and then ride it to capture larger gains than normally might be attainable from an intraday trade. Swing traders hope to profit from strong price swings, so they hold the asset, whatever it is that they're trading, usually for 2 days to somewhere around a few weeks, in the hopes that the significant swing will happen sometime during that period, with the market continuing on with the trend that they anticipate. Let's take a moment to understand the process of swing trading. So the markets themselves, they move in what we call waves. We have waves up, then we have waves down, and then we have waves up. The swing trader is looking to capitalize on these waves by taking advantage of these longer term trends that are occurring across a period of days, whereas a day trader is looking to capitalize on profits that are happening within a single day, generally speaking. So they're not taking advantage of all of this. Instead, they're trying to take advantage of the price fluctuations that are happening in the much shorter time frame. So the idea behind the swing trade is to capitalize on those swings and capture small gains, but with an overall larger trend backing you up. So even though the gains might be small, when executed properly and consistently over time, they can easily compound into pretty great annual returns. For example, a position or trend trader might wait 6 months to earn 30% profit, whereas swing traders might earn steady 5% gains every week and eventually record more gains than the other traders in the long run, adding up to that. There's no fixed period of time for holding swing trading positions, as it can vary from a few days to even months. Additionally, while some traders are always looking for those volatile markets that have a lot of movement, others might prefer more steady markets. In any case, swing trading is about enduring as little pain as possible by quickly entering and exiting our trades before the opposing pressure comes into the market. Swing trading looks simple enough on paper, although the idea behind all trading is going to be important on the execution process behind the person that's actually employing it. Swing traders want to pay attention to the fees like commission costs as well, of course, to make sure it doesn't start eating into their profits over that longer time period. As with any investment strategy, swing trading comes with its fair share of advantages as well as drawbacks. So we're going to take a moment to talk about some of the pros and the cons. As far as the pros go, swing trading doesn't require us to spend hours in front of our monitor on a daily basis, since we can hold our positions for days to weeks, even sometimes months. Investors with a full-time job have the ability to take advantage of swing trading, since they can simply enter a position, set their stop loss, and go back to focusing on their jobs. So that's another big plus for the swing trading. Also, swing trading essentially presents less stress compared to many other styles of trading on the shorter term like day trading. Another pro is that swing traders mostly need only to rely on technical analysis to enter or exit the market, which in turn simplifies the trading process even further. Then comes the cons. And for the cons, the first one is the fact that traders that are in the swing trading atmosphere aren't always able to ride trends perfectly because they're not monitoring their charts 24/7 like day traders are. Also, as far as the cons go, traders often deal with overnight and weekend market risk in the swing trading category because, once again, they're holding it longer than a day. And then finally, there's always the risk that sudden market reversals can wipe out all of the short-term gains that we're doing with swing trading. And when I say short-term, of course, I'm meaning relevant to the longer-term style of trading like position trading. Swing trading and day trading do share certain similarities naturally because they are next door neighbors, but there is still that one defining difference between the two of them. We have a much different position holding time. We discussed that swing traders have to hold their positions overnight to several weeks or even months, whereas day traders must close their positions before the close of the market for that day. So here we're going to go over a few different categories of how these two differ regarding day trading and swing trading. The first is going to be capital requirements. There are variations in the capital requirements depending on the type of market being traded when we compare day trading and swing trading. A day trader that's holding futures contracts will have a different capital requirement from a swing trader that is trading traditional stocks. For example, if a day trader is trading stocks in the US, their account usually is going to be required to be somewhere around $20,000. On the other hand, there is no set legal minimum for swing trading stocks. Still, swing traders must make sure their trading accounts are sufficiently funded if they actually want to see profits. Then we have potential returns where they differ. Day trading usually revolves around wanting to make a quick buck through compounding returns at each session. However, it's not always that easy because it means they have to make twice as much as they lose while also winning at least 50% of their trades. For inexperienced traders, this can easily result in faster losses instead of faster gains. Meanwhile, swing traders tend to accumulate gains slower while looking to cut losses quickly, but even though their potential gains are slower to accumulate, they still have the ability to grow into large gains over time. Then we have position sizing. Because day traders must close their positions before the market closes for the day, they tend to take larger positions, especially since they're constantly monitoring the charts for any sudden price changes. They also often trade with leverage in order to maximize their profits, given that their more frequent trading can lead to higher transaction costs, which can be considerably eating away at their profits. Swing traders, on the other hand, often have to deal with the risks associated with holding their positions overnight, and therefore tend to take smaller position sizes in general. Let's take a look at some common swing trading strategies out there that traders swear by each and every day. The first one is going to be the trendline trading strategy. This is easily one of the most popular swing trading strategies out there. Buying at the bottom and selling at the top in this strategy means we have to understand how to place trend lines, so that is going to be our little prerequisite here. But once again, the idea behind this strategy is relatively simple. We're using a technical indicator to identify and confirm the market direction as well as the momentum. We're looking to take a long position if the trend is going to reach higher highs and there are no bearish signals along the way. Then we're looking to take a short position in this scenario where we were to have a trend line looking something like this over here on the left, where we were just reversing the rules. We'd be looking to take that short if we had no bullish signals along the way and we were adhering to our trend line. So relatively simple concept here. We're using a trend line to outline the lows and get ourselves in somewhere near that low point while the trend still pertains. Then we have the floor trader strategy. This is a simple yet powerful trading strategy that is looking for retracement opportunities and employs only two indicators. We have a 9-period exponential moving average and we have an 18-period exponential moving average. This is the idea behind this one. We're looking for these two lines to cross, preferably in the scenario where the 9 is crossing over the 18. With that, we have an indication that the current trend is getting stronger and is in agreement with the longer term trend, with the longer term EMA being the 18. What we want to see is we want to see candles that are continuously trading above both of these lines like we have right here. After we see that, we're looking for an opportunity to enter in during a good time of value. That means we need price to fall back down. When we reach around our 18-period moving average, all we want is a bullish confirmation candle. That's what we got right here. A bullish confirmation of a potential reversal of this short-term trend to go back in agreement with the long-term trend. After that, we're looking for our long scenario. If we were looking for a short, we would just reverse this image entirely. But that is our long scenario. Our stop loss can be placed on a number of factors, but ultimately the idea here is to focus on where we need to get in, and we can get out when these two lines cross again if we have no idea where to place our stop and we are new to trading. Next, we have the range trading strategy. This is a very popular strategy, but it does require a very specific market scenario. We need the market to not be strongly bullish or strongly bearish, and we need it to actually be going really nowhere. We want it to be bouncing back and forth between two centralized locations, with the majority of price trading somewhere in between those two locations. Almost how a Bollinger Band works is what we're kind of really looking for here. We want 90% of price to be somewhere in between these 2 points, but we want to see a lot of reversals happening over and over again around this point where we have wicks coming up, touching this area and rejecting heavily. We don't even want to see too many candle closes on or beyond this area as well. So the goal here is, as the market works its way to the bottom and it has no real strong directional bias, bullish or bearish on the longer term, we're looking to take advantage of a long when we're down here exhibiting some type of bullish rejection setup. Usually price action alone is good enough to give us this. And the same thing goes for our short scenarios. For our shorts, we want to look for some exhaustion occurring around our centralized area of resistance, and we're just simply looking to short the market. Our goal and our target for these trades would be each of the other lines. That means if we got in down here at the bottom, we're looking to exit somewhere closer to the top. The closer we get, the more likely we want to get out of the position, because a rejection may as well be coming. Our final trading strategy is the fading trading strategy, which is relatively dangerous in nature due to the fact that we will be going against the trend, the overall trend that is, when we are doing this strategy. So I strongly urge caution, but that does not mean that this cannot be profitable for some traders. So I wanted to share it with you guys nonetheless. So the concept here is we're going to identify an overall trend. So here we can clearly see that we have a long-term bullish trend. We can identify this with a number of ways. We can use our trend lines, we can use Bollinger Bands, we can use moving averages. It doesn't matter how we do it, whatever we prefer, but we want to get a nice strong overall trend read. Then what we're looking for is we're taking advantage of the times where the market gets a little too overzealous and moves a little bit too far away from its average rate of incline. So for example, over here, if we were to just draw a line straight through this, looking like this is a terribly unstraight line, but you get the idea here. There are periods where the market does get a little bit more bullish than it needs to and actually ends up getting sucked back towards the overall average. So what we want to see is one of these periods where we're working quite far away from our overall price average on the main trend, then look for a reversal candle, and we're looking to short that situation with the opportunity to get out as soon as we see any main trend confluence coming back to the market. So we want to short here because we have ourselves a little pin bar, and we want to exit here because we found ourselves a doji candle, and that is a potential reversal scenario, so we want to get out. So basically short-term trades here relative to most swing trading styles, but this still will be done over a period of days. As we discussed, there are certain strategies that favor specific market conditions that are under the broader umbrella of swing trading, but overall, when we're starting out looking for a pair or something that we want to swing trade, there are certain market conditions that can help that go in a more beneficial way for us. And some of those things that we want present are things like a large market capitalization. We can sum this up just by saying strong liquidity. It doesn't matter if it's a stock, it doesn't matter if it's a futures contract, it doesn't matter what it is, it doesn't matter if it's commodities. We just want a liquid market. This means we have the ability to get in and out when we want to, and that is important. Then we also usually prefer for swing trading a relatively calm market. This is because we're holding our position for a few days to weeks and maybe even a month, so we don't want to experience extreme volatility during that time, shortening our overall life expectancy in the trade. And finally, we have catalyst. This means securities themselves have a catalyst to trigger a powerful move in its market value. Some of those things are ideal for swing trading, but we need to be aware of what they are. So whatever market that it is that we're investigating, we want to make sure that we're also aware of the catalyst behind that market. In conclusion, now that we know what swing trading is compared to other popular trading styles out there, we'll be more prepared to deal with various market conditions. There are conditions that favor day trading more, and then there are conditions that might be favoring swing trading more when we have consistent grindy stocks or indices or whatever it is that we're interested in on. Some of those things out there that we might want to take a look at if we're trying to get started with swing trading are companies that have some of those strong trajectories like Microsoft or MasterCard or Visa. Those are all great swing trading environments for beginning swing traders. But if you do think that you've got it down mastered, please make sure you check out the Gauntlet Mini and prove what you've got. But until next time, folks, thank you for joining me again. It has been a pleasure as always. Please click the like and subscribe button down below, and I will see you in the next one. Cheers, folks!